we've been saying this for the last 18 months, that we are in a rolling recession. It started 18 months ago with 2 consecutive negative quarters for real GDP growth at an annualized rate. And since then, one sector after another has stumbled. So housing, for example. Housing, by many metrics, is down 40 to 50% on a year-over-year basis. That is a recession. In fact, it's worse than a recession. We've gone back to COVID lows. We're not far from 08, 09 lows. And remember, the housing crisis is what started that global crisis off.
Cathie Wood, the visionary CEO of ARK Investments, takes center stage to deliver a comprehensive market update for the year 2023. Recent reports are buzzing with the suggestion that Federal Reserve policymakers are poised to usher in an interest rate hike later this month. In an atmosphere where inflation persists, these officials are proceeding with caution, determined not to repeat the mistakes of the 1970s when hasty attempts to control inflation resulted in a resurgence of double-digit price increases. The Federal Reserve's unwavering vigilance is evident as they assert that it's too early to declare victory over inflation. The market's response has been remarkable, with both stock and bond prices ascending to new heights, reflecting the financial world's unshakable trust in the Federal Reserve's commitment to upholding economic stability. During this illuminating interview with Cathie Wood, she provides valuable insights into her market outlook for the year 2023. She offers a thoughtful analysis of the economic indicators we can anticipate, with a specific focus on inflation, the stock market's performance, and the potential influence of cryptocurrencies on the global monetary system. Cathie Wood's expertise and visionary approach make her a pivotal figure in the ever-evolving financial landscape, and her guidance serves as an essential resource for investors and those keen to understand the intricate dynamics of the financial world. Her adept grasp of market forces and emerging technologies solidifies her role as a prominent thought leader in the financial sector. As the financial world braces for changes and developments, Cathie Wood's insights provide a beacon of knowledge, guiding us through the complexities of economic evolution. Her commentary offers a crucial perspective that helps shape a nuanced understanding of the forces at play in the contemporary market, and her dedication to exploring the impact of disruptive technologies makes her a respected authority in the financial industry.
We now have government gridlock. What happened with the House Speaker being ousted suggests that the government could shut down in the next 6 weeks. So I know there's a lot of nervousness around government spending, which up to now has been a stimulant. We think the next year, election year, is going to be more along the lines of gridlock. Inventories, if we listen to our companies and to other companies that we don't own but monitor for their cyclical indications, many are saying that inventories are dropping. They're dropping dramatically at the retail level. And yet we don't see that in the overall economic statistics. In fact, the revision to real GDP in the second quarter showed inventories flipping from negative back to positive. So we haven't seen a broad-based inventory decline yet, and we do think that is coming. One of the ways we're seeing it is in the trade sector. So our imports are dropping, I believe, a double-digit rate, because I don't think economists and investors spend enough time understanding what is happening in the rest of the world. And we think the rest of the world is experiencing much more pain than we are. Certainly China, increasingly Europe, and of course they influence the rest of the world. This is the federal budget deficit as a percent of nominal GDP. And as you can see, we're in the 7.5% to 8% deficit range relative to GDP. So if you look at this in the context of history, I remember when I first got into the business, and in the early 80s, we were running a deficit north of 5%. That was because we had back-to-back recessions. You can see those shaded lines there are recessions. And the government was doing what it typically does, trying to become a buffer against the hardship caused by recessions. So we got to 5.6% deficit as a share of GDP. And I remember the ruckus being raised there. And one of the answers to curing that deficit was growth. So tax cuts, regulations being cut, tariffs being cut, and real growth being stimulated. And we do think that that will prove to be the case again. Now, you can see what happened during COVID and during the great financial crisis. Our government threw everything it had at both of these crises. And you can see we've come back, but, in the absence of a full-blown recession, 7.5%, 8%, very high by historical standards. And some would say that it is quite discouraging. Perhaps we are in this rolling recession. Those who think we're not in a recession can look aghast at this number, but it would suggest that we could be in a recession, and there are some contracyclical spending measures taking place in addition to the stimulus coming out of COVID, the COVID crisis, and the so-called Inflation Reduction Act. M2 growth being negative on a year-over-year basis. This is percentage decline. And you can see it's in the -3.5% to 4% range. You haven't seen this. You don't see it on this chart. You'd have to take this chart back into the 1930s to see it. Now, the other side of this is we had that burst of money growth up to 27% during COVID. Again, the Fed throwing everything they had at it. And so this is a natural reversal, but this is more now than a year-long decline. So now we think it is starting to bite. And if velocity drops, and you've heard me talk about velocity before, the rate at which money turns over, then this will exacerbate the downturn that we expect. Now, we can already tell that velocity is starting to diminish. It was growing very rapidly to get back to trend after COVID, but it never got back to trend, and it is slipping again. But we know the housing sector is stuck. And that is often, the movement in the housing stock often unlocks a lot of equity and increases the velocity of money. That is not happening. So we are concerned that money growth is still negative, and we do worry that velocity will fall and compound the impact of this year-over-year decline. Now, here is the long-term perspective on the 10-year Treasury yield. And you can see history going back into the 1800s. Now, the Fed came into existence in 1913, so you can eyeball it there. And if you look at the chart before that, we rarely went above 5% interest rates. And you can see what happened afterwards. Especially after 1971, when we closed the gold window and monetary policy became unhinged. The Fed effectively accommodated the quadrupling of oil prices that OPEC put through right after that. And you can see what a disaster that was throughout the 70s and into the early 80s. And then in the early 80s, again, we had really good fiscal and monetary policy, fiscal policy encouraging growth, monetary policy, Chairman Volcker just saying, we are not accommodating these price increases. Money growth never went negative. In fact, I will show you back there. If you look in the 80s, you'll see in the early 80s, money growth was in the high single-digit range. It never went negative. And inflation and interest rates came down. And we went into a 40-year bull market in bonds. Now, what has happened since the low in interest rates in 2020 is we have had the worst bear market, I think, ever. And interest rates were at such a low level that it didn't take much of an increase to cause outright losses in bonds. And if you look at what has happened and tally it up. If you use the 10-year Treasury bond, I think the losses in terms of principal have been something like 45%. If you use the 30-year, it's more like it's more than 50%. So those are the sorts of declines we saw in the stock market after the tech and telecom bust, and then in the global financial crisis in 08-09. It doesn't look like it's severe, but it's just the low rate from which it started. And this is also an incredible problem for banks right now. They have a lot of assets on their books with very low yields. They piled into Treasury assets during COVID, thinking that interest rates certainly wouldn't go up for years and years and years. And you can see they hadn't gone up in years.
Throughout the year, one of the central areas of Cathie Wood's keen focus has been the shifting landscape of crypto legislation within the House, underscoring the burgeoning interest in the cryptocurrency sphere. While it's acknowledged that crypto-related legislation may encounter hurdles due to political opposition, Wood maintains that the very presence of these dialogues will prove beneficial for the cryptocurrency market. This, in turn, is anticipated to unlock a myriad of growth opportunities in the months ahead, marking an optimistic outlook for the crypto industry's evolution. The recent interview with Cathie Wood offers a comprehensive platform for her insights on pivotal subjects, including government debt, rapid economic growth, and the continuously unfolding cryptocurrency landscape. Wood's capacity to navigate these multifaceted discussions firmly establishes her as a prominent figure in the financial realm. Her reflections on the intricate interplay of government policies, economic dynamics, and the emergent cryptocurrency sector are particularly noteworthy. We encourage you to share your reflections on this interview and Wood's astute commentary, as your contributions are integral to the ongoing dialogue surrounding these influential factors, further enriching our collective comprehension of these significant issues. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.